I think there also is the growing awareness that because the debts are so big, because interest expense as a percent of GDP is so big, because it's the biggest single line item, I think there is, and because this is going on all over the world. Again, this isn't just in the United States. China just this week, talked about potentially having to do QE. So there is this growing awareness that all fiat is going to get debased. Again, fiat gets debased throughout history. This is nothing new. But I think there's this growing awareness that it may have to happen at an increasingly rapid rate in order to handle all these global debts. And so people are saying, even if the Fed doesn't cut now, and even if they don't do as many cuts as we're expecting, and as a result, the markets pull back 15% or 12% or whatever, they can't let it go too long before they then really cut rates in order to get it going higher again. And so I think there's some of that going on as well, is that they're saying, well, they're saying the Fed put is back, even though Powell is saying the Fed put is not back, the markets is saying, yeah, right, we know you're going to be there to save us. And so I think there's a little bit of chicken going on between the market and the Fed.
As a central bank, we have the ability to create money digitally, and we do that by buying treasury bills or bonds or other government guaranteed securities, and that actually increases the money supply. We also print actual currency, and we distribute that through the Federal Reserve banks.
Hey everybody, and welcome back to Milkshakes Markets Madness. My name is John Kutsmeda. This is Brent Johnson. We have milkshakes in our name because Brent came up with the dollar milkshake theory, which talks about how the US dollar works in the global financial system. We'll let you go down that rabbit hole on your own using the Start Here playlist on the channel homepage. But we're going to get into markets. We just wrapped up Q1 of 2024. Brent, why don't we just start right there? We have a lot of things to talk about, but give us your thoughts on the first quarter of the year.
Well, this year is it's funny. The first 2 weeks of the year were a little rocky, but after, we got in a little bit into the second week and everything reversed higher, and it's really just kind of continued what happened in Q4 of last year. And so, markets finished Q1, equity markets finished their Q1 at all-time highs. Gold finished Q1 at all-time high. Bitcoin finished Q1 either at all-time high, where we're within a stone's throw of it. The dollar was up 2 or 3% in the first quarter. And so, this is kind of the milkshake. This is kind of what I said for a long time, was that we get into a period where gold, dollar, and equities, U.S. equities, all rise together. Now, whether they continue to all rise together or not, I don't know. I've always said that there will be terrifying drawdowns along the way. And, I've been expecting a drawdown, but we just haven't had one. And so whether that comes now or comes later in the year, we're going to have to wait and see. But, I will say that the people that have been bullish have been right. And people who have been sitting on the sidelines are just waiting for that pullback. And the people that have been short have gotten burned pretty hard. And so, I think a little bit this goes to the other thing that we talk about a lot is the bull market uncertainty continues. The bears are certain that they're going to be right. The bulls are certain that they're going to be right. The gold guys are certain that they're going to be right. Bitcoin guys and girls are certain that they're going to be right. And everybody on Twitter is always certain about everything. So, this bull market uncertainty is there. There's no doubt we have a bull market uncertainty. So, I'm excited for Q2.
Well, look, one of the things too, we're not going to beat the table or pound the table on the dollar milkshake theory and the dollar, but the important aspect of it is that this is a relative game. And I think that's the thing that people constantly miss, partly from your view. You talked about, people who have been bearish have been really, really hurt. One of the things we see frequently when anybody's favorite asset does well, partly because you're so vocal on all sides of the table, they love to use you as a target and say, hey, this is why your investors aren't doing well or why your portfolio is not performing, not understanding that, number one, there's a risk management procedure, right? If you have $5,000 and you want to YOLO that into Bitcoin at 20K and it goes to 60K, congratulations. But if you have $5 million, you have a very different approach to how you want to manage that money. And you're not so worried about chasing the 20% returns as you are making consistent 8 to 10% returns with very low risk. So with that being said, feel free to add some context to that. But also I started this question making reference to the dollar being a relative game. So when you're seeing kind of this early stage of the milkshake where assets in the US are going up, the dollar is stable and getting stronger, are you seeing something different in global markets?
Well, not really. One of the things I've talked about before is, when I look at a place to allocate capital, I can place it in the US, I can place it in South America, I can place it in Europe or Asia. But it comes down to a relative game. I've got to put it somewhere. You can't just sit in cash all the time. And so part of the thing that helps me make that decision of where I want to go, I think, what are the possibilities in the years ahead? So the possibilities in the years ahead are that maybe all of this angst about a coming crisis and, the debt's too high and everything's going to blow up. Maybe that's wrong. And maybe we just continue on like we are and the whole world grows together. In that scenario, the U.S. is kind of outperforming the rest of the world. But even if the rest of the world was outperforming the United States, and, we have, in the first quarter alone, equity markets up between 5 and 10%, that's not a whole, that's a 20% return annualized. I'm, me and my clients, I think we're pretty happy with 20% a year annualized. So I don't see, with that type of return possible in the US, I don't find it necessary to go try to find investments overseas, whether it's in Europe or Asia or South America, Africa, wherever it is, and then take on what I perceive as an additional risk for doing that as well. So that's one thing about placing assets in the US. The other thing that could happen, that's if everything just stays fine and goes well. The other thing that could happen is we could go into a crisis. A lot of the stuff that people are talking about and they're worried about, maybe this crisis does appear and the whole world goes down together. Well, in that scenario, I think the U.S., again, on a relative basis, will be seen as the global safe haven. And so if everybody goes down together, even though it wouldn't be great to be in the United States, it'd be better to be in the United States than anywhere else. So again, I choose to put my money in the United States. The third thing that could happen is we could have the market would continue to do great or even just do okay in the United States, but be really bad elsewhere in the world. And that's happened on several occasions. There's been several times where the U.S. economy kind of chugs along and we have kind of an emerging market crisis or some kind of a Latin American crisis or an Asian currency crisis. And that would cause some ripples back in the United States, but maybe it wouldn't be horrible. So that's one thing that could happen. So in that scenario, again, I'd prefer to have my money in the United States than have it overseas. The fourth thing that could happen is that the U.S. could go into some kind of a spiral and recession or depression or some kind of a crisis, and the rest of the world shrugs it off and continues to grow, and they do great. Now, while I say that fourth thing is a possible, in that scenario, then I guess I would prefer to have my assets overseas. But the reality is when I analyze the world and understand how the system works, the possibility for the U.S. to become go into a huge recession and the rest of the world shrug it off and thrive in that environment, I never say anything is impossible, but that's about as close as it gets. And so even in that environment, I don't want, and I think that's such a low probability, I would only allocate a very small part of a portfolio to that potentiality. So in all of these things, I prefer to have my assets in the United States, right? And so on a relative basis, that's where I think the most of the growth is going to be. I think that's where the most of the safe haven assets will flow if a crisis does develop. And so right now, I don't see the need, even if, right now the Nikkei is at its high and the DAX is at its high. So the assets around the world are doing okay right now. It's not like the US is, running higher and they're all falling, with the exception of China. China continues to fall. But the point is I don't see the need to go overseas when, the returns are basically here in the US and the likelihood of the rest of the world outperforming the US dramatically is pretty low. And so, that's the way I look at things. And I think the Q1 is a very good reflection of that. If you look at the last 2 or 3 years, the U.S. has dramatically outperformed the rest of the world. And again, every time you get into a crisis of the last 25, 30 years, it's literally 100% correlation to when a crisis or develops in the world or when the global economy slows down, the dollar rises. So again, my framework for the dollar milkshake, even though we haven't gotten the crisis, the framework has allowed me to stay invested, ride the wave, and not get wiped out when the inevitable drawdowns come. We've had 2 or 3 drawdowns over the last 4 or 5 years, We've been able to remain invested through those. We lost a little bit of money when those came along, but not like we didn't experience the big drawdowns that most people did. The flip side is we didn't make quite as much money, in the bull market, the recovery phase, but we didn't have to make as much coming out of it because we didn't lose as much going into it. And so I think that's, for me and my clients, I think that's the right strategy going forward. And so there'll be times where we underperform and there'll be times where we outperform. But I do kind of feel like there are times where people are, most people, not most people, a lot of people are heavily invested in either one asset or one asset class. Now, whether that's precious metals, whether it's crypto, whether they're all in on equities and the Magnificent Seven, or maybe they're all short treasuries. I seem to interact with a lot of people who have very concentrated bets and they're all in on one theme. And I just don't think that's the right way to go about it. And part of somebody is overly emotional in one asset whenever that asset starts doing well, they start, chirping in your ear. And they, we were talking before about how they have to get rid of that pain that they've been feeling for so long. So gold is a good example. Now, I've been a gold bull for as long as I can remember, or not as long, but 15 years. I've owned gold. I think everybody should own gold. I literally think it's the most important part of anybody's portfolio. I've helped a number of people buy gold over the last couple of years, but I don't feel it's necessary to go out and pound the table on gold all day, every day. There are plenty of people at conferences on Twitter that just constantly pound the table on gold. And if that's what they want to do, that's fine. I don't feel like I add a whole lot to that conversation. I mean, essentially, the argument for owning gold is that fiat currency gets debased over time. You want to own something real. Gold has a 5,000-year history. It can't be inflated away. It can't be debased. It can't be destroyed in some kind of a deflationary collapse. And it's a put option on political idiocy. That's the case for gold. So once you know the case for gold and once you own it, what else is there to do, right? And so, again, I think everybody should own that. But, where I do think I add value, where I do think I bring kind of a fresh perspective is to what the dollar is doing. And so that's probably why I talk about the dollar more than I talk about everything, even though I'm not just sitting in dollars. We own a lot of equities. We own a lot of T-bills. We own gold. We own various commodities at times. And again, I think a diversified basket way to go, but it is funny when you get into a bull market in a single asset or a single asset class and people feel the need to finally release some of the angst that they've been feeling themselves.
Yeah, all right. Well, there's a lot we're going to pull on there, but I want to go back first to the scenarios that you laid out. The last one you had mentioned being very, very unlikely, and we'll get into why, because it more or less goes back to the euro dollar market and this idea of exporting and importing inflation, mainly as the dollar being the reserve currency. But before we go there, you're talking about, we started off talking about Q1, the performance of markets. Now, how do you think, if the current trend, this kind of ripping bull market continues throughout the end of the year, what does that do for a lot of managers, number one, but what do you think that kind of sets the market up for? And in addition to that, when you have this narrative, and again, we all kind of live in various echo chambers, and I feel like the market's doing one thing, but at least for me, the thing that I see the most and hear the most is a lot of people screaming from the mountaintop that the crash is coming. And this has kind of been, these voices have been very loud since 2021. So despite 3 years of being wrong, there's still that deep sense of certainty. So it'd be interesting to hear not only how you think this trend can potentially continue and what that means for markets at the end of the year going into next year, but also how do you feel when it feels like everybody is coming at this market, not only from certainty, but from this end of the world bearish sentiment?
Yeah, it kind of reminds me of 2018 when 2018 and 19, Powell had started to raise rates. There wasn't as significant a rate hiking cycle as we've had in 2022, but he started to raise rates after, several years of no rate hikes or very little rate hikes. And everybody was predicting recession. Everyone was predicting a big crash. And I remember at the time saying, if we get a crash in this environment, it is going to be the most predicted recession or crash in history. And, we ended up getting the crash, but we didn't get the crash for the reasons that people were predicting. A lot of people were predicting we're going to get the crash because of rate hikes, or we're going to get the crash because, earnings aren't what they are, or we're going to get great crash because the debts are too high. That isn't why we got the crash. We got a crash because, we had a pandemic and they literally shut the world down. And so we got the crash. And then, but now it kind of reminds me of that again, with the rate hikes, not everybody, but if you walk into a room and say you are bearish, or you're expecting a pullback, or you're expecting a crash because rates are too high, the debts are too high, the U.S. budget deficit's out of control, you will not, that is not a contrarian position. Nobody is going to say, wow, that's really insightful, because many, many, many people have that opinion. Now, positioning is different. There's a lot of people positioned in the market where there's not a lot of fear, and people are net long and they're levered long. So I agree that the positioning is different than the sentiment, but the sentiment is sentiment is high, but you are not seen as this wild contrarian if you think that we're going to get a pullback or some kind of a crash. And so typically you don't get a big crash or a big kind of a pullback when a lot of people are expecting it, unless you have positioning the way it is. And this is why I have said for a while, I'm expecting a pullback. I still expect a pullback, but I'm not betting everything on the pullback. I'm still long. I still think equities go much higher in the years ahead. But I just think we're in an environment where you can't just be long without some kind of a protection on the downside. Now, whether the protection on the downside is in the form of T-bills, maybe it's puts, maybe you have some asymmetric hedges, maybe you're relying on gold or Bitcoin for it. But the point is, I don't think that this is an environment where you can just be levered long without worrying about it. And I kind of have a couple scenarios. My base case scenario, and this is not new. People who've been listening for a year know this is my case, is that I think the market needs a pullback, or at least a pause, in order to reset sentiment a little bit, in order to provide the fuel to then go to all-time highs, which I think is we're going to continue higher in the years ahead. But the longer we go without getting a correction, and again, a correction might only be 8%, maybe it's 13%. I don't know, but I think we need some kind of a pullback in order to kind of reset sentiment, reset positioning. But if we don't get that, if we don't get it, and the longer we go without getting it, it increases the probability that when we do get it, it's bigger and more severe. So if we get some kind of a correction or a pullback, let's call it in the next 2 or 3 months, sometime in Q2, I would expect that that would be a dip that you would buy, because then I would expect the markets to run higher into the end of the year, into the election, into the first half of next year. If we do not, and I think that could continue even for a couple of years even. But if we don't get a correction this year, and this pace that we're on continues, and we go higher in Q2, higher in Q3, into the early part of next year, then I think it's possible that we could get a pullback that may last a year or 2 years, of something more severe. In other words, there's a lot of people who are predicting a crash and a crisis and, a big bear market, a 2 or 3 year bear market, a depression. That's not my base case. I actually think things are going to be volatile, but be volatile to the upside as well. But I will admit, the longer we go without getting the correction, the higher the likelihood of some kind of a bigger correction becomes.
Well, conceptually, I get that, right? There's this, the more stretched the rubber band is, the more the counter reaction needs to be. But if part of the rallies we've been experiencing the last 2 or so years has been the markets moving on the expectation that the reaction mechanism from the Fed is going to be accommodation. So if that's the result, whether it happens in the short term or 12 months from now when the rally is even longer in the tooth, why do you think that response mechanism would be less effective, later in a bull market cycle, or a bull market that's lasted longer?
Well, I do think, I think people to a certain extent got over their skis on the rate hikes are bad for equities, and rate hikes automatically mean recession, and when we've talked about this before, people can listen to earlier episodes where we've discussed this. And but I do also think that higher rates are kind of, especially at these levels, they will have an impact. as we move forward in time, as more, loans get reset to the higher rates, as more houses get reset to higher rates, as more commercial real estate finally has to get marked to market. If interest rates don't come back down and treasury bonds, as they get sold, now they get marked to market. I think that kind of stuff does come up I think that will have an effect on the economy, and that is therefore then what leads to a potentially bigger drawdown. I'm just not convinced that we have that right now. And again, I'm not convinced that it's a huge wipeout. Again, we've talked about this, but I'm much more worried about a crisis developing overseas than I am about one developing in the United States. It's not to say that one can't develop in the United States. I'm just saying that's not the one that I worry about every day.
Well, there's plenty of powder kegs burning so far overseas. We won't touch on that right now, maybe a little bit later in this conversation, maybe another conversation altogether. But on the topic of maybe giving the bears some fuel in this conversation, there's not been a ton of data that's somewhat reinforcing that narrative, but we're starting to see, as you mentioned, the commercial real estate market has been one that people have been talking about for a long time. But one of the things that, recessions, for example, generally are defined by 2 consecutive quarters of negative GDP. Last week, we talked about inverted yield curves, and you had mentioned, well, maybe we already had the recession. It was very, very short when we did have those 2 quarters of negative GDP. Now, the current administration brushed it off and said, well, it's not just 2 quarters of GDP. There's other factors that we need to sprinkle in. Obviously, for political reasons, they wouldn't accept that, there was a recession, even if it was shallow. But one of those other elements is employment. And at the time, employment was still pretty strong. Now we're in a very important election cycle. And so when it comes to employment data like the non-farm payroll, we've seen some very, very strong numbers. But then ironically, the month later, they get dramatically revised lower. And what we're starting to see, there's been some articles recently that, even the Bureau of Labor Statistics, et cetera, have admitted that, there's a bit of inaccuracy to this data and that the jobs numbers aren't as good as they've been reported. But at the same time, we are seeing other important data sets as far as monetary policy and all the things we're talking about in terms of the trajectory of the economy, such as inflation data, remaining more anchored. So the Fed is kind of really trying to thread the needle here, where the things that they don't want to see go wrong in the economy, like unemployment increasing, is starting to potentially be a concern, while at the same time, inflation data is not really giving them the room to come in and save things if the bears finally do get it right and some sort of crisis unfolds domestically.
No, I mean, that's absolutely right. I mean, the Fed is not in an easy spot right now. If we start to see a slowdown in job growth, and you start to see unemployment actually pick up, and we're starting to see that. And then, Powell even said last week that, we're seeing good progress on inflation. Well, some of these inflation numbers are being revised higher. And then, we got a PCE today that came in higher than expected. So, you're seeing with the fundamental strength of the economy weaken, and you're seeing the downturn in inflation stop, and perhaps, again, who knows, perhaps start to tick a little bit higher again. And that's not what the Fed wants to see. But I think to a certain extent, again, markets, they climb a wall of worry. Maybe people have heard that term before. There's always somebody worried about a crash. There's always things that can go wrong. But yet, the economy just kind of chugs along. And I kind of feel like the coming Fed rate cuts have become the new version of China's going to stimulate the markets. Part of the reason that markets took off at the beginning of 2023 and never really looked back, other than, a few weeks a year ago in March, with the banking issues in the US, part of the reason that they took off and kept going was it felt like every month you would get the thing, well, China is really going to stimulate this time. China, because again, coming out of COVID, China did less than the rest of the world, and they remained in kind of a malaise longer than the rest of the world. and that they resisted stimulating the market. Well, then, in late 2022, they were like, well, now we're going to stimulate, and they would try stimulus plan, and everybody get excited, and then it didn't come. But then, well, we're going to do it again, and then it didn't come. Well, now we're really going to do it, and the market, just kept going on it. And I kind of feel like that's the Fed rate hikes now. Is yeah, we thought they were going to maybe cut in March, and they didn't, but now they're going to cut in June. But even if they don't cut in June, well, then they're definitely going to cut in July, and they're just chasing that the future easing. And I think there also is the growing awareness that because the debts are so big, because interest expense as a percent of GDP is so big, because it's the biggest single line item, I think and because this is going on all over the world. Again, this isn't just in the United States. China just this week, talked about potentially having to do QE. So there is this growing awareness that all fiat is going to get debased. Again, fiat gets debased throughout history. This is nothing new, but I think there's this growing awareness that it may have to happen at an increasingly rapid rate in order to handle all these global debts. And so people are saying, even if the Fed doesn't cut now, and even if they don't do as many cuts as we're expecting, and as a result, the markets pull back 15% or 12% or whatever, they can't let it go too long before they then really cut rates in order to get it going higher again. And so I think there's some of that going on as well, is that they're saying, well, they're saying the Fed put is back, even though Powell is saying the Fed put is not back, the markets is saying, yeah, right, we know you're going to be there to save us. And so I think there's a little bit of chicken going on between the market and the Fed.
Well, for the long-term livelihood of fiat, you kind of need a balance with the debt markets. And if we do have a crisis and there's defaults and there's write-downs, that's bullish for fiat in the sense that those debts are written in those currencies. And, if we have some sort of debt crisis, then all of those markets have a moment in the light, right? So
that's right.
If we're going into a situation where everyone's expecting the Fed or China or whoever it is to kind of come in with some sort of stimulus to rocket markets higher, do you think there's a big misunderstanding, or they're overlooking the reality that before that happens, you could have this massive gaping hole in the debt markets that make the demand for fiat exceptionally higher?
So this is why I'm going to tie this a little bit back to what I was talking about earlier about the way I had decided to try to navigate the next, I don't know, let's just call it 2 to 5 years, is that my whole strategy here is just to survive in advance. Now, if I see an opportunity to make a lot of money along the way, because things are really mispriced in one place or another, then I will absolutely try to take advantage of that. But my goal is not to try to get everything absolutely 100% right. My goal is to set the portfolio up in a way that we're kind of ready for anything. No matter what happens, we're not going to get blown up. We're going to just kind of very steadily, earn capital and earn returns, and we're going to kind of get through this time period, which I think is going to be I think it's marred by great risks along the way. No, it doesn't mean you're going to crash. It just means that the opportunity to crash, I think, are going to be great. I think people have an higher belief that the Fed knows what they're doing and can say things than perhaps they actually can, right? Again, the Fed will be there. If the system comes under pressure, the Fed will absolutely react. But just because the Fed reacts does not mean that they will initially be successful. And I'll use the 2008-2009 crisis as an example. In the summer of 2008, when things were starting to implode, Bernanke was saying everything's contained. And then when things really started to go haywire in September and October, they launched massive stimulus plans, TARP. It didn't work. Right? And then they came out and they did something else and it didn't work. And it took them 6 months and another 10, 20% of downside in the equity markets for them to finally get control of stuff. So again, just because the Fed comes out and cuts rates, just because they go back to QE, it doesn't mean that automatically immediately means that markets are going to rebound. I think a lot of people remember back to COVID when they were kind of blindsided. They cut rates, but that was about it. And then 10 days later, markets were down another 20% from where they cut rates. And then they came in with the bazooka and they did everything. And that was and we had the V-shaped recovery. There's nothing to say that we have to have a V-shaped recovery. Just the way that we've said, just an inverted yield curve doesn't mean you have to have a recession, right? Just because you have higher rates doesn't mean you have to have a crash. Well, just because the Fed reverses policy and goes to easy money or does QE doesn't mean it has to rocket asset prices back higher. And so I think people who believe that all you have to do is be levered long, either equities or real assets, because fiat debasement is here and it's here to stay, and the Fed put is alive and well. I'm not saying those people are wrong, but it doesn't mean you can't get hurt along the way anyway. And what I don't want to have happen is I don't want to become a distressed seller in a drawdown. I want to be a distressed buyer in a drawdown. And if that means that I have to trail a little bit in the upswings, I'm more than happy to trail a little bit in the upswings in order to be a distressed buyer when the drawdowns come along.
Well, it's interesting. Your firm is called Santiago Capital. For people who don't know, it's kind of a nod to two characters from different books, The Old Man and the Sea and The Alchemist. You talk about going on this journey and some of the risks along the way. And a lot of iron and somewhat ironic is the full circle that we eventually come back to, which is very similar to the journey that Santiago goes on in The Alchemist. So I think there's there's more inspiration besides just the name, perhaps. But one of the things that's interesting too, though, is, talking about the potential response from central planners, central bankers, etc. One of the infamous speeches during the, I guess it would be around that 2018 timeframe, maybe a little bit sooner, when Draghi had made the comment that they would do whatever it takes. More recently, the country that now has the spotlight on them and is going through some challenges is Japan. And the finance minister, Suzuki, said something similar. Do you have any thoughts on when these central bankers come out and ultimately kind of make these strong stances? Is that, the end of the road for them, or is this a time for the bears to watch their hands, that they don't get them cut off?
Well, I think the answer is both of them. Listen, you cannot ignore central bankers. Central bankers are incredibly powerful. Now, as much as you may want to ignore them, I think at least, if you have a 5-year time frame and a drawdown along the way doesn't matter, then you can ignore them. Go play golf, go sail a boat, do whatever you want to do. But if you're marking your book every month, every quarter, every year, it's really hard to ignore central bankers because they are incredibly powerful. And just their words can move markets, let alone what they actually do. So, I do think that it's likely that should the yen experience more weakness, that they would do something. And when I say I don't know what they would do. Maybe they raise rates. Maybe they go and buy yen in the market on their own. Maybe they intervene in either the FX or the JGB market in order to support the currency in some way. I would expect them to do something, but I don't expect them to win. They might win for 6 weeks. Maybe they win for 6 months. But I think the yen is ultimately going to 200, and then it's going to 250. Now, that's a huge drawdown from here. That's a lot lower than here, but that's what I think is going to happen, because I think for all of the things that people worry about will one day happen to the United States, Japan is already there. And ultimately, you cannot save both the bond market and the currency market. I think the yen will be the market that they sacrifice in order to save the JGB market. If you let the JGB market go and you don't save it, well, then your banking system implodes and you can no longer finance your government. So it's unlikely that they're going to let the JGBs go. When the central bankers come out and say these things, it's getting rough for them, and that's called jawboning. And central bankers are great at jawboning. They're trying to scare people, and a lot of times it works for a short period of time, but eventually it's like the little boy that cried wolf. The cries become, just a distant annoyance, and you no longer pay attention to them. And I would expect the same thing with the yen.
Yeah, well, we'll see what happens there. It's one of those things where eventually, everybody eventually they have to pay the piper, so to speak. And
Yep.
One of the things, as you mentioned here, is that for all the arguments that people make about where the U.S. is headed, Japan is currently there, has already been there. But what's important to keep in mind is at one point, Japan had the lost decade, and now they're very closely approaching 4 decades.
Yeah.
So as you often say, this can go on a lot longer than expected. But while we're on central banks, especially those overseas and the different things that they can do, you kind of brush by the fact that, China is always kind of doing some kind of stimulus, but they hinted at what, I think Western markets would consider to be more a narrative around actual QE, using the term open market operations. Do you want to talk about that a little bit more?
Yeah, I probably should talk about this because and I'll talk about it for a couple of reasons. Number one, like China's in a lot of trouble. There's all these people that will tell you that it's all a 3D chess move and this is actually a good thing. Meanwhile, if the exact same things that were happening in China were happening in the United States right now, people would be, apoplectic about how bad things were in the U.S. But Xi came out this week and he said, it's very clever kind of the way he said it. And he basically said, I think the central bank governor, who he had just appointed a year ago, he sacked the previous one and put his new guy in there. And now he says, in my opinion, yeah, right, okay. When Z says, in my opinion, that means you better do it or you're going to be disappeared, right? So he says, in my opinion, the central bank, the PBOC, should be using open market operations, which basically means the central bank going into the marketplace and intervening in the marketplace. We think the PBOC should use open market operations to trade CGBs, which is basically Chinese government bonds. He didn't say buy them. He said trade them. But are they going to go sell them? No, of course they're going to buy them. Or maybe, who knows? But the point is he basically said it without saying it, right? And so people are saying, well, would that be QE? Yes, it would be QE. If the CGB is out there buying government bonds, that would be QE. But what I find hilarious, if Jay Powell had said something like this, or if Biden had said something like this, or if Trump was president and he said something like this, the dollar fatalists and the American fatalists, the self-loathing Americans would be all over it. This is just another example of the failed empire. They got to print money till the cows come home. But when Z says it, they're not a peep. Nobody on Twitter is like worrying about it. You're not going to read about it in the newsletter. And to me, it's just hilarious how people, you can see the same piece of news for one country, and it's this amazing story, and it happens with another country, and it's just, it's no big deal. It's 3D chess. And it's amazing. It's madness.
Well, we are heading into March Madness. You did touch on the fact that, in a lot of ways, your goal over the next who knows what time frame is just to survive in advance. That's kind of a theme of the basketball tournament. But whether it's Japan or in this case, I think China is the most relevant one to use, when they get into creating stimulus, or if there's a currency debasement, which whether they do directly or the market decides because they're inflating their currency away with QE, there's this idea that you have talked about multiple times that is ultimately that country exporting their deflation by importing inflation. And we've had, one of our listeners, Jimmy Olsen Blues, ask about this a few times and just recently asked again. He said, I still do not understand how to export or import inflation. So can you give a little bit of context on how that dynamic works?
Sure. Think about it this way, is that there's a couple different ways that the U.S. can do it, and there's a couple different ways that other countries can do it. Think about this. Internally in China has a lot of deflation. The asset prices are falling, the debts are too big, and it's putting downward economic pressure on the country. That's deflation. One of the ways that you can counter deflation is to weaken your currency. That's the whole point of doing QE. When, think of it in the U.S. in both 2008 and 9, and then again in 2020, when asset prices came down and the dollar went up, the central bank went in, did QE, did open market operations, did special circumstantial programs. They do that to weaken the currency, to bring the currency down and push asset prices back up. Okay, same thing is happening in China now. The asset prices are coming down, the debts are too big, it's putting deflationary pressure. So what they can do, if they were to devalue their currency, it would mean that now the asset prices would rise in terms of their currency. The debts would be easier to pay, but that deflationary pressure has to go somewhere. So when the yuan falls, that means the dollar rises, right? So now they devalue the yuan, that pulls inflationary pressures into their country. It releases that deflationary tension. That deflation gets sent abroad. As the deflation is leaving China and entering the United States, it pushes the dollar price up. That happens at the time that they devalue the dollar. As the dollar price goes up, now our assets start to come down. So in other words, they've taken the deflation away from China and pushed it to the United States in this example. Now, the way the U.S. can do it is a couple different ways. By running a tighter monetary policy for the U.S., that can actually, it's funny because they can then force other countries to have to print more of their currency in order to service their U.S. dollar debts. And as they print more of their currency versus the dollar, their currency loses value, and now they experience higher inflation in their country than the U.S. does in theirs. So the U.S. sent the deflation out of the United States and sent it into theirs. That's one way. The other thing is just by the fact that the euro dollar market allows the U.S. to print. We're not going to get into that, but euphemistically print a lot of money, and they can print money and they can send it abroad to buy goods and services, right? And by sending the money abroad, that money doesn't stay in the United States and circulate in the United States. If all of the money that the U.S. government printed stayed in the domestic United States, we would see a lot higher inflation, because though there'd be more money in the United States, that would push up prices, that would be inflationary. The fact that we export dollars around the world, because we pay for goods and services all over the world in dollars, and because the rest of the world trades amongst itself in dollars, they take our supply of dollars into their market. That decreases the supply of dollars in the United States, and that keeps inflation on somewhat under control in the United States. So that's a way that we can export our inflation to other countries. And this is why the euro dollar market is so important. There's no other country that even comes close to having an external market for their currency that the U.S. has, right? So in other words, when Turkey prints a lot of lira to combat their, economic problems, that lira stays inside Turkey. And so then they get inflationary pressure in Turkish lira terms. Same thing for, Brazil, same thing for Argentina, same thing for Indonesia, same thing for India. There's not a huge market for rupees outside of India. So if India was to produce or print a bunch of rupees, it's going to stay in India. It's going to push prices up in rupee terms. And that's why the dollar rises in value versus the rupee. But the euro dollar market, because the euro dollar market is much bigger than the U.S. domestic dollar market, the U.S. can get away with a lot of monetary operations that no other country can get away from, because it's an external source of demand for their currency.
Just in case anyone who's never heard of the euro dollar market, has never watched other videos, everything you just said was a good explanation. But can you give a quick 30 seconds on what euro dollar market means?
Sure. So a euro dollar is basically a dollar that exists outside the United States. And so for a lot of reasons, if you're not familiar with this market, you're just going to have to accept that this is true until you've done the work to come to understand it. There is a huge market that takes place in dollars outside the borders of the United States. Countries trade amongst themselves using dollars rather than local currencies. And that creates an incredible amount of demand for dollars outside the United States. These countries and institutions outside the United States have also taken on incredible amounts of dollar debt. They have borrowed, and they've borrowed in dollars. And so there's an incredible amount of demand for dollars outside the borders of the United States. So just think of the borders of the United States. That's the US dollar market. Everything outside that border is the euro dollar market. The whole world uses dollars, and the whole world has demand for dollars, so it allows the U.S. to export its dollars, export its inflation to that market, and it takes it out of the U.S. domestic economy.
And one thing I'll add too is that these foreign actors are also creating U.S. dollar loans, even though they don't have the capacity to actually print dollars to cure those loans, which is a big part of your dollar milkshake theory and why there's a long-term dollar strength, despite some pretty poor fiscal policies in this country. Now, in our Start Here playlist on the YouTube channel at the top, we have a couple clips associated with that playlist that dive into this. So I encourage people to watch those. Again, they're clips, they're 10, 15 minutes, so you can get a deeper sense of what Brent is talking about with the Euro-dollar market. Now, before we wrap up here, you did touch on it ever so slightly in the beginning, in terms of how gold has been performing recently, and just generally how people who love gold, have been quick to cheer and applause its recent performance. But do you want to talk about gold? It's all-time high. It's not something that we've actually touched on in more recent episodes, even though we should have. So let's give it a little bit of a moment here. But not only has gold and precious metals continued to climb, but the miners have lagged. Do you want to talk about all of those?
Yeah. So listen, I think I said it earlier this episode. If I didn't, then I'm going to say it again now. Like, to me, I actually consider myself a gold bug, somewhat of a unique gold bug, in that I don't mind and I don't worry about saying that gold could actually go down once in a while. A lot of gold bugs think it can only go in one direction. They think it's holy. They think that's all you should own. And they think that if you own anything else, you're foolish. That's not the type of gold bug I am. I think it's an incredibly important part of the portfolio. I actually think it's probably the most important part of a portfolio. I think everybody should own it. I think it will be the asset. If we look back, 5 or 10 years from now, I think it will be the asset that, quote unquote, kind of won the war, so to speak. So I think, again, I and for all the reasons that I elucidated at the beginning, I think people should own gold. And it's pretty amazing what gold has done. Gold's at 22, 25 or something like that right now. And it's kind of done it quietly. To a certain extent, I think the fact that the Magnificent Seven did so well last year, and I think the fact that crypto has done so well over the last year, it's kind of stole gold's thunder. And so gold has kind of quietly come up to all-time highs, and it's it doesn't surprise me that it's all that it is this high. And I do think that oh my God, I'm laughing just thinking of this, because listen, sentiment in gold now is high. Sentiment in everything is at its high. I don't like buying anything at its all-time high. I don't want to buy equities here. I don't want to buy Bitcoin here. I don't want to buy gold here. I don't want to buy land here. I don't want to buy anything right here because it's at its high. I'm glad I already own it, right? I mean, we've owned gold for years. I actually helped some clients buy gold last summer when gold was like $1,850. And so, that has been that has obviously gone the right way for those clients or that client, but it's also gone. So the people that already own gold, our clients that already own gold, did just as well from 1850 to where it is now as the guy that bought it at 1850 and it's where it is now. So I think I said this at one point, is part of the reason that I don't pound the table on gold, other than every interview I give, I say it's the most important asset, that everybody should own it. And in the very first interview that I ever gave where I spoke about the dollar milkshake theory, I said the dollar will rise and gold will rise together versus all other currencies. And I specifically said the dollar will rise versus other fiat currencies. And I explained why it's important to understand that gold will rise versus other fiat currencies, or why gold will rise against fiat currencies in general, and why it's important that dollar will rise versus other fiat currencies. And when those two rise together, along with U.S. equities, that's the milkshake. And that's kind of what's happening. So I find it kind of funny when people now come to me and say, oh, the dollar's not very strong because the gold's going up. Well, yeah, but the dollar's going up versus other currencies as well. And yet equities are going up versus other currencies as well. In other words, gold going higher in no way hurts my thesis. Does it mean that I think the gold's going to $5,000 tomorrow? I don't. Now, will it? Maybe. Will I be upset if it does? No, that's fine. I'm not predicting it, but the reason I own gold is I don't know when it's going to go. I just know that it eventually will, and I'd own it as an insurance policy as a result. I do think it's interesting that while gold finished its all-time high at the end of the quarter, silver made its high about 10 days prior, and it's now below where I would have liked to see silver breaking out above its all-time high going into the, or at least its recent high going into the end of the quarter. And the miners too. The miners had a big run up into the end of the year. They pulled way back down in January and February. Now they've had a big run back up about where they were at the beginning of the year. So, and they're not even anywhere close to their all-time high. So I think when we really get into a bull market in gold, both silver and the miners will be flying much higher as well. So if we see those break out over the next couple of weeks, then I'll say, well, maybe now it's time for gold to really, really go on a run. But the thing is, it's already had its run. So, it's had a good run, and it doesn't need to run higher for it to serve its purpose in my portfolio. But I would say if people don't own gold, you should absolutely own some gold. You should, and if you don't own any at all, you should buy some now, even at the all-time high. I'm glad that we've owned it for years, so we don't have to go buy it at the all-time high. But if you don't own any gold, go buy some now. Don't buy it all right now. If you want a 10% allocation, buy, I don't know, 2 or 3, 4, 5% of it now, and then leg into the other 5-6% over the next 6 months. But I do think everybody should own gold. I think it's a crucial part of a portfolio. And to all my friends who are in the gold world and who have been these long-suffering, gold bugs who have said, it's got to happen. Well, I'm very happy for them because they're very excited, and to those who stayed in the trenches and stayed with it, I'm sure it feels good for them to feel some vindication now.
Well, I will just say enjoy it while it lasts, because nothing lasts forever in markets. And certainly in precious metals and gold, I don't think there's anybody who's been more beat up, given how the narrative certainly supports the argument for it to be much, much higher. So hopefully everyone who's invested is enjoying the run, and anyone who isn't letting the pain and their ideologies change an objective view of how to continue to invest in the markets going forward. And hopefully this conversation gave you some objectivity to consider no matter what you're trying to do. We appreciate everyone joining us. You can find Brent on Twitter at Santiago AU Fund. You can find me at John Kutsmeda. You can find this show at Milkshakes Pod, both on Twitter and on YouTube. Again, we're glad that you're joining us, and we hope you continue to do so. We'll see everyone again next week. This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.